Hey, in this video, I'm going to talk about 5 mistakes you might be making when it comes to your tax-free savings account. We have lots to go over, so let's get started. Hey, welcome back. This is Thomas, here to help Canadians make better choices on retirement, wealth, and insurance. My goal is to make sure you can take 1 or 2 ideas home and make better financial decisions today. If you find value in this video, consider subscribing so you will never miss any of my videos. Let's jump into it. Tax-free saving account is one of the Canadians' favorite investment accounts, with nearly 15 million Canadians having one. However, not everyone in Canada knows the account's true potential, so in this video, you will learn 5 common mistakes Canadians make with their tax-free saving accounts. The first mistake is an obvious one. You don't have a tax-free saving. New data from the CRA has shown that as of December 2018, there were 20 million tax-free saving accounts, but they are held by almost 15 million unique tax-free saving holders. Keep in mind that there are only 30 million of Canadians who are 18 and above, meaning 1 in 2 Canadians who are above 18 years old do not have a tax-free saving account. Also, when we add all the money in the tax-free saving account together, there are roughly $300 billion in the pool. So if you do the math, this means that the average Canadian with a tax-free saving account of the fair market value had $20,000 at the end of 2018. Only 1/3 of the maximum contribution. In addition, CRA also shared the demographic breakdown by age and income of those who use the tax-free saving account. Interestingly, 1/3 of the tax-free saving account holders are under the age of 40, 28% between 40 and 65, and the remaining are those over 65. I'm a firm believer to start saving at a young age. So this stats is particularly nice to see because younger Canadians are thinking about this. Now you might think, I don't have a tons of income to start saving yet, so can I just start later? CRA also shared the breakdown of the income levels. 52% of the tax-free saving holder make under $50,000 in their total income, which is slightly lower than the Canadian average income. The average tax-free saving account balance at December 31st, 2018 was $20,300 for those tax-free saving holder with an income between $20,000 to $90,000. Of course, those who had high income levels had high average tax-free saving balance, with $90,000 to $250,000 income bracket holding $27,000 tax-free saving balance, and those over $250,000 income with $43,300 in their tax-free saving accounts. If you don't have a TFSA yet, think about how you could contribute little by little, and maybe even through automatic payroll deductions. However, there are situations where I wouldn't recommend a tax-free saving, and I will talk about that later in this video. The second mistake Canadians make with the tax-free saving account is assuming it is only a savings account, instead of seeing it as an investment account, and just because of its name. Your tax-free saving account holds your savings, but it can also hold equities like stocks, GIC, bonds, ETFs, or mutual funds. And when you have those investments inside your tax-free saving, your investment can grow tax-free. If you only use a TFSA for savings, then you are actually losing value of your money over time. For example, the current saving rates in the banks can be as low as 0.1% per year. In 2021, we are seeing a 1.6% inflation, and in 2022, a 1.8% inflation. Therefore, in the real return, you are actually down 1.5% this year and 1.7% next year. Keep in mind, these inflation rates are the result of the current state with the pandemic too. So inflation can be higher, which means the value of the money will decrease even more. With this low interest environment, unfortunately, we do have to take some risk now by investing into the markets. Now, if you treat your tax-free saving as an investment instead, either with a balanced or growth portfolio, you should see a 3 to 5% per year return in average or higher if you hold it longer. While these aren't guaranteed, you can see chances are it will be higher compared to using it as a savings account. With this in mind, the tax-free savings should actually be called the tax-free savings and investment account, don't you think? Hey Thomas, no problem. I like to invest in stock and I plan to become a day trader in one day. If you're a pro with investing with your tax-free saving and think you can get away with day trading in your TFSA, think again. The CLA will audit, so you don't want to get a large penalty from doing this. What I meant is, TFSA do not allow you to take money in and out too frequently. While there are no guidelines to this, the CLA does say that a TFSA is meant as a savings and investment account for Canadians, not for traders to profit from it. I do see a few friends of mine got a warning letter because of that, so watch out. The third mistake many Canadians make with the tax-free saving is over-contributing. The contribution room for tax-free saving in 2021 is $6,000, and this is the same limit for every Canadian regardless of your income level. And with the $6,000 addition, the total cumulative contribution limit for someone who has been a resident of Canada and is at least 18 years old since the tax-free saving began in 2009 is $75,500, and you can carry forward any unused tax-free saving room you haven't used in the previous years. However, you also can go over your limits, usually because of two reasons. One being you are too young to entitle all the tax-free saving room. For example, if I was 18 years old in 2009 and up until today, then I will have $75,500 of the tax-free saving contribution room. Versus if I'm born in the year of 2000, which now I'm 21 years old, then I only have $23,500 of tax-free saving contribution room. Did you know in that of the 15 million Canadians who have a tax-free saving, 8.5 million of them contribute to that tax-free saving in 2018. 1.4 million contribute their max entitled amount, with the average contribution being $7,800 compared to the max tax-free saving in 2018 being $5,550. This means a lot of Canadians were catching up from the previous years. So while for most, you might have a lot of room from previous years, but if you don't, you can accidentally go over your limit with this mistake. Wondering what happens if you go over? You will have a penalty tax of 1% per month. For example, if you contribute $2,000 over your limit, then you will have to pay $20 every month as long as you are over in your tax-free saving. To check your limit, you can log into the CLA account online, and there's a section where it shows you your contribution limit. It may not reflect your contributions or withdrawal from the current year, so you'll need to remember if you've done any. Another way to check is to call the CLA and they can provide you with the information. The other reason, which is the fourth mistake with the tax-free saving, is withdrawing and contributing to your tax-free saving in the same year. Going back to mistake number 3, this is actually the easiest way Canadians over-contribute. For example, you have $6,000 limit this year, so you contribute all $6,000. Later, you decide you need to take out $3,000 to purchase something, so you think I should still have $3,000 remaining for the year, right? But this is wrong. Withdrawals will only add back to your contribution room at the beginning of the next year. If the limit next year is also $6,000, then you should have a total room of $9,000. And if you did add the $3,000 back in the same year, you will now be $3,000 over in your tax-free saving, and at 1% penalty tax, you will be paying $30 a month. Side note, you'll always want to withdraw your tax-free saving when you are positive on your investments. For example, say you max out your tax-free savings $75,500 and now the market value is at $90,000 and you withdraw everything. Next year, you can put back the full $90,000 plus a new additional $6,000, which means your room is now $96,000, which is higher compared to the others. And the last mistake I see as a financial consultant when it comes to the tax-free saving is not looking at your finance as a whole. This is why it's a good thing to find a professional to look at all your finances so they can help you make the most of your money. I've seen clients contribute to the tax-free saving even though they have large credit card debts. credit cards have high interest rate, usually at 20% or more. And even if you're investing with your tax-free saving, earning 3 to 5% per year, the money would be better off if you pay off your debt first. Or in other situation, you have a very good income, which also means you have to pay a lot of income taxes. So putting into the RSP first may be better off, because now you may be able to generate a higher tax return, and then you put the tax return back to your tax-free saving to further boost your savings. So how many of these mistakes you had made before? Leave a comment below. Don't worry, we have all done it, but hopefully this video clears up the common ones I see often. And if you know anyone that's going to open a tax-free savings soon, please send them this video so they can shorten their learning curve. Hey, thanks so much for watching. This is Thomas, and I'll see you in the next video.